Hello everybody, this is Toni Turner and welcome to the market now as of Friday, April 24th at the close. Well, new orders for key U.S.-made capital goods unexpectedly rose in March, but the gains are unlikely to be sustainable amid the coronavirus outbreak, which has virtually shut down the country. Also today, President Trump signed a nearly $500 billion coronavirus relief bill into law to expand loans for small businesses, and that's good news. So now let's go on to three charts that could give us some insight into the week to come. First of all, as we always do, we're going to look at a daily chart of the S&P 500 SPDR, symbol SPY. This is the exchange-traded fund that closely follows our S&P 500 index. Now, when I captured this chart today, at the close, the SPY was trading at $283.45. And again, we're actually right where we were a week ago, pretty much, and right where we were pretty much 2 weeks ago. The SPY is now off of its all-time highs that we know up here was on February 19th at $338.34, or about $33.83 on the S&P 500 itself. As you all know, the SPY fell from those all-time highs down here to a low, March 23rd low at $218. So right now, where we're trading here at $283.45, the S&P 500 is now 16% off of its highs. So it is in correction territory, but it's no longer in bear market territory. In fact, the S&P 500 has clawed its way back up 30% down, 30% higher from the lows at 218. So that's good. And again, it's essentially what waffled sideways for the past 2 weeks. We're pretty much again where we were last week for sure, and the week before. Today now, the good news is you can see the green line coming down. This is the 50-day moving average. And today, the SPY moved its head up and closed above that 50-day moving average. It did so about 6 trading days ago, but couldn't maintain it, so it did it again now, and it is trading again at $283.45. We do have resistance up here at 287 or 2870 on the S&P 500. We do have support down here at about 272, 273, 271. And then more support down here, potentially at about 264, more support here, about here down about 244 or 2440 on the S&P 500 itself. So we're sitting here in this sideways motion. As you know, that means the bears are pushing down, the bulls are pushing up, and it's in a pressure cooker going sideways. It is trading above now with the red line, the 20-day moving average. That's a good thing. Again, just above the 50-day moving average. And up here, of course, is the 200-day moving average moving horizontally. At least it's not coming down overhead too badly. So what we have here, this is when they talk about a W recovery or a V-shaped recovery. This would be a V-shaped recovery so far. There's always little stops along the way here. There has to be, there usually is at any rate. But now we see if the SPY, if the S&P 500 can stay at these levels, we have at least another 2 weeks, 2 to 3 weeks of earnings coming out. Be very interesting to see what the guidance is for some of the large cap companies. And so we have to see if it can stay at these levels and move higher, or if the SPY needs to come back down, at which point we'll be looking to see what that shape is if it comes all the way down to 245. Hopefully not. Hopefully it stays above those levels. But for now, we've got a V-shaped recovery in the market trying to happen. We'll see if that is able to continue. Our next chart today is a chart of the Invesco QQQ. As you know, the symbol is QQQ, and this ETF represents the NASDAQ 100, a very important index in the market. The top holdings are the large cap momentum stocks like Facebook, Amazon, Apple, Intel, Microsoft, that whole group. Now, at the close today, when I captured this chart, the QQQ was trading at $214.15. Its all-time high was on February 19th at $236.98. And now it's just 10% off that high. So it's actually moved up pretty much, except for the last week, couple of weeks, it's moved up and down, pretty much like the SPY. But it is positive here. It is higher over its 50-day moving average. And again, it's just down about 10% from that all-time high. If it moves up, 10% is correction territory. If it moves up above, back up, heading up back toward 220, it will even be out of correction territory if the QQQ can pull that off. It has climbed 26% from its March low down here at about 165. It's traveled up 26% from that low, so that's positive. Now we have nearby support here at 205, and then of course potential support here. There is a gap here, but it's trying to get filled. We do have potential support also at the 50-day moving average coming in at $202.41. Actually, all three moving averages on this chart, the green, the 50-day, the black, the 200-day, and the red 20-day, are all pretty much right in this neighborhood of 200 to 202. So that's good news for support. The more indicators we get in one place, that always means there's possibly a little more strength there. And of course, we do have more resistance up here at about 216. So again, just like the SPY, we'll have to see how the earnings season goes in the next couple of weeks. Certainly see how COVID-19 plays out, and hopefully we get some kind of advancement on vaccines, and a cure would be wonderful from that. So we've got a lot going on right now. We'll have to see what happens. I'm really trading one day at a time right now. I've had people ask me on Twitter, are you long or short? I'm really kind of neither. Well, a little bit long and a little bit short, but I'm mostly in cash right now. I just can't, I don't know, except for very short-term trades. I'm not making any ultimate decisions here about which way the market's going, because absolutely none of us know. Okay, our next chart here is a chart of the S&P Spider Retail ETF, the XRT. That is making a very decent pattern here if it can play out. The retail ETF has 87 top components, and of course, as we all know, retail got hammered in this pandemic. Top components here are Rite Aid, Stamps.com, Etsy, Amazon, of course, Kroger. Now, it made an all-time high, and you can't see it on this chart. It doesn't go back far enough. In August of 2018 at $52.95. Today, the XRT at the close was trading at $34.68. So at that price, the XRT is trading 50% off of the all-time highs. So as far as the XRT goes, it is in bear market territory, but I did like the look of this pattern. It sold off dramatically. Now we can see here a double bottom. The double bottom was complete when price moved above the V, kind of we'll call it, the middle of the W. Price moved above that. So, and actually this is one way of buying Amazon if you want to, because it is one of the top components, and it's a lot less expensive to buy the XRT than it is to spend, I think it's about $2,400 on one share of Amazon. Yeah, 2,407. So if that, I just thought I'd throw that in there for what it's worth. So we do see here that it's low down here in March. The XRT's low was at $26.29. Since then, it has moved 32% off of those lows. That's a good thing. I like the double bottom, as I said here, and then the handle that it's building. I like that. You can see it's kind of going sideways as the S&P and Qs have been doing. I am going to see, what we do have here is the 50-day moving average coming down overhead. Volume has been a little lower here, as you can note here, than it was back for the last couple of months when everything was falling so hard. So now we have a little bit of steadiness coming in here. What I want to see now is if the XRT in the coming week can move up and over and close above $35, which if that happens, 35.06 to be exact, but if that happens in the next few days, if it moves up and over the 50-day moving average and can close above it, and I may say, hey, I'm not getting in until there's 2 closes above it. If it does break above 35, I may buy a small position. I will put a tight stop in. My stop will be at 32.50. That's my initial stop. And as I've said before, in this market particularly, if for whatever reason the market starts rolling hard to the downside, I may exit the trade without waiting for it to reach my stop. On the positive side, if the XRT can push up here and move above 36, I may add a few more shares to my position, and of course, I will turn my stop into a trailing stop. So you may want to keep an eye on the XRT in the coming week. And now, please know that I've temporarily suspended my usual list of next week's economic reports to briefly touch on the topic below. So if you want to see a calendar of the economic reports, you can go to toniturner.com, click on Education on the top toolbar, and then click on Economic Reports. I thought we'd talk this week about an emotional and a mental way of approaching the market by starting out with a question, as we've been doing recently. The question this week is, do I constantly second guess my trades? Do I constantly second guess my trades? And a lot of traders do this, especially novice traders. It's totally understandable, especially in this market. But when you constantly second guess your trades, it makes you, it either wears you out or scares you out is exactly what happens. Sometimes you jump out and the trade just screams higher without you and you think, oh no, or it makes one little quirky move to the downside and you jump out without looking at your plan. So to stop second guessing your trades, rewire your thinking just a little bit, because second guessing our trades can immerse us in a very big mire of stress. Of course, it results, everything does, from a fear of losing money. Certainly it can be a fear of being wrong, which in the stock market, sometimes we are wrong and sometimes we're right. So it's the fear itself, though, that clouds our thinking. As I say, it puts like a gray lens over our eyes. And second guessing isn't good for our trades. It's not good for our account or certainly our personal well-being. So to stop second guessing your trades, rewire your thinking and then take action. First, accept that occasional losses are part of the trading game. That just is part of it. Next, make sure you have a well thought out trading plan for each trade. This is key to success in trading. A well thought out trading plan. Now, once your trading plan is in place, please, accept that losses are part of the game. Make sure you have a trading plan. And once you have your plan in place and you've entered the trade, either buying for long or selling short, place a hard protective stop. A hard stop means you're placing a protective stop with your broker. So that takes, as we said in the old days, the worry out of getting close. The decision is made for you. Once you make that decision and enter the stop with your broker, the decision is made for you. I really like to do that myself, and I do it on almost all my trades because that alleviates stress. I go, all right, this is on automatic now. It makes me feel more confident. And please know that if your trading plan is well thought out, your wins should be bigger than your losses, and you will be a constantly profitable trader. So all this is very, very important, especially if you're second guessing your trade. Make sure you've got a plan for every trade, put in a hard protective stop with your broker, And if your plan is well thought out, you will be a consistently profitable trader. Okay, now as I go into the final words here of this, please know that we have made a 20% discount on all of our training programs is now available to you. All you need to do is click on the orange button below, and at checkout, enter the discount code right here, 20 product, and product, of course, is in uppercase. So discount code 20 product. And you can either go to this link right here, toniturner.com, training.com/training programs. There's another slash there. Or just click on the orange button below. So I hope you all have a great week. Please be careful out there. Keep green on your screen. I'm Toni Turner, and this is The Market Now.